special issue, and we thank the support of Elsevier for that as well. So we are very privileged to have several distinguished speakers throughout these 2 days of the conference, and all of the bio sketches are available in the program. We haven't been able to give a detailed introduction of each of you. But I just wanted to note for today's keynote that we're especially honored to have joining us from Tokyo, from Japan, Mr. Hirotaka Unami, who is the Senior Director for Policy Planning and Research of the Minister's Secretariat of the Ministry of Finance in Japan. He joined the Ministry of Finance in 1989 and has served in many different roles within the ministry, from Deputy Director of the Budget Bureau, Finance Counselor for the Embassy of Japan in France, Counselor for Social Security and Tax Reform, Cabinet Secretary, Executive Secretary of the Chief Cabinet Secretary of the Prime Minister's Office, Director of the Budgets of METI and the Ministry of Environment, and Senior Director for Social Security Budget in the Budget Bureau. And professional career has mainly focused, as you can tell from this extensive experience, on the field of Social Security reform. In particular, he was closely, indeed authored, the 2011 Social Security and VAT reform, as well as the more recent Social Security reform plan and others, jointly with others. He was elected by a top business magazine in Japan as one of 125 Japan's next leaders. He has a BA in economics from the University of Tokyo and a master's in economics and finance from the Sloan School of Management at MIT. Please join me in welcoming Mr.
Unami. Good afternoon, ladies and gentlemen. Thank you, Dr. Eggleton, for a very kind compliment. It is an honor to be invited here, and I think it's a privilege to speak in front of the distinguished guests. Japan is facing a rapid aging society, and therefore we are facing the most severe policy challenges of financing longevity, which is the issue of this workshop. I'm a policy maker, and so my presentation is by no means academic, but still I hope that our experience have some implication for the workshop's discussion. So on page 1, the content of my presentation today is described. In the first half of my presentation, I would like to illustrate the overall picture of financial impact of aging society in Japan. And in the latter half, I'd like to present the policies that we have taken or are planning to take to tackle with this issue. Okay. I'll begin with the first half. The basic idea of Japanese social security system. When I say social security system for Japan, it includes medical care. It also includes long-term nursing care and pension system. It basically includes almost all the cares that we provide. It is a combination of 3 concepts. First, it's a self-care. Based on this concept, there's a private insurance, such as the private medical insurance and the DC corporate pension. And second concept is mutual aid. It's provided through public insurance, sorry, such as medical care, long-term nursing care, and defined benefit pension. Large part, I would say most part of Social Security in Japan is provided through this system called public insurance system. The third concept is public aid, welfare service to the disabilities, and welfare payment to the low-income household fall into this category. Service providers may be private, but in terms of financing, they are 100% funded by the government. Now, the characteristic of the public insurance system through which the bulk of our services is provided. It's different from private insurance in 3 main aspects. First, its subscription is mandatory, which means that it is full covered to all citizens. Second, the citizens are secured with full access to all services. Third, financing is different from private insurance in 2 ways. First, although the insurance premium is a precondition for each individual to be entitled for benefit, but the large part of the resource is redistributed from low-risk group to finance high-risk group. In other words, the insurance payment paid by working generation are redistributed to the elderly and low-income household. And in addition to that, heavy government funding is provided to the system for the high-risk group. As you can see, I'll show you in figure 1. This slide describes the budget structure of major public insurance system. The left two shows the pension system. The pension system. In pension, employee pension is basically self-sustained, the second from the left, whereas for the national pension, which is the basic pension for all population, this is 50% financed by the government, the red box. Towards the 3 boxes on the right-hand side is for the medical care. Insurance for age 75 and over, which is the third one from the right. This is heavily supported both by the redistribution of working ages insurance premium and government financing. Among the working age, government finance is provided for the non-employees, which is the second one from the right. Is provided for the non-employees to compensate for the lack of bearing capacity while assuring the same level of healthcare services, exactly the same as for the employees. So when you see the proportion, actual proportion of the elderly's payment for the medical care and the long-term nursing care, which is the center 2 parts, it is about like 10% or 20% is actually paid by the beneficiaries, and for else it is redistributed from the working age, or it is provided through the government's financing. Now, the demographic change in Japan, since 1990s, Japan is facing a rapid aging of population together with declining birth rate. In other G7 countries, such demographic change began earlier and expected to develop more moderately in the future. As you can see on the left-hand side box, the red line shows Japan. This is the ratio of people older than 65 years to the total populations. So we are facing a very rapid aging society compared to the other G7 countries. Now, okay. Looking into the future, the second bullet, Japan expects to see a large increase in age 75 and over population between 2022 and 2024, as the baby boomers, which were born between 1942 and 47, reaches the age of 75. The healthcare and long-term nursing care costs per capita increases rapidly from the age of 75. Okay. This slide describes the difference in healthcare and long-term nursing care spending per capita by age groups. Left side is healthcare, the right-hand side is long-term nursing care. In the healthcare system, the right-hand side, the per capita cost for age 75 and over is 6 times larger than that of age 65 to 74. So when we say elder, the actual cost is quite different after 75. What is more important is that when the government financing is concerned, this ratio is as large as 5 times. So as for the 75 and over, the public subsidy per capita is about 5 times as large as those for age 65 and 74. I will elaborate more in the following slides, but the fact that we are expecting a large increase in age 75 and over population in 5 years we're not just facing an aging, but a super aging society. It will have a significant impact when the system's financial sustainability is concerned. So the budgetary impact of aging population, increasing payment to the elderly will require larger financing, both from insurance premium and public finance. The public premium rate increases as the demographic proportion of elderly increases, and also when the wage growth stagnate. But the larger burden on government finance is as I explained, is larger. The financial impact is larger on government's budget because, as I showed you in the figures before, its relative share is larger for public insurance systems targeted for elderlies. Okay. The right hand, this shows the total amount of Social Security benefits. It's a prospect towards the future, and the right hand side shows the budget structure for this benefit. The right hand picture shows the increase in Social Security benefits and the change of relative share of government's burden for financing it. In 1990, the total amount of Social Security benefit was 74 trillion yen, which is, well, approximately $500 billion. And approximately 1/3 was financed by central and local governments. In 2020, the total amount of Social Security benefit has more than doubled to 109 trillion yen. And the relative burden of governments has increased from 34% to 40%. And this trend is expected to strengthen towards the future, especially in the early 2020s, as the volume zone population reaches the age of 75. So as a result, within the national budget, the budget for Social Security has tripled in this 25 years. It shows the difference in 1990 and 2015. It shows the difference in expenditures and the revenue of the general government. As you can see, the 2015 budget for Social Security, which is this red box, it shows that I was in charge of this budget last year. The amount is 31.5 trillion yen, which is about it's about $400 billion. And it has tripled since 1990, whereas the total amount of other policy expenditures stays relatively the same in nominal terms in this 25 years. Looking at other factors, the 2015 National Debt Service, which is the yellow box, has also increased, but only by 64% due to low interest rates, whereas the total debt stock increased by 400% in the same period. Our debt stock is about 200% of GDP now. The government has failed to secure enough tax revenue to finance this increase, and resulting in a constant issuance of government bond, which is the pink box, and accumulation of government bond. So to summarize, the Japanese budget deficit largely results from financial imbalance between the growth of Social Security expenditures and tax revenue. Compared with other OECD countries, Japan is way off from the golden rule, i.e. the balance of benefit and burden. I just want to jump to, okay. This graph, it's a tiny graph, but this graph shows the Social Security expenditures and tax and Social Security contribution in OECD countries. The vertical axis shows the total size of Social Security benefit as a percentage of GDP. I'm sorry, yes. And the horizontal axis shows the actual burden of the population, both tax and insurance premium, again, as a percentage of GDP. The golden rule is that in order to maintain the system financially sustainable, we must stay in the 45-degree band. The color, the area colored in blue on this graph. Like such countries as France and Sweden stays in the upper right within the band, and on the contrary, the United States sits in lower left, just outside the band. The position of Japan started from the very lower left corner after the World War II, you say 1955. We have expanded the benefits aiming for the welfare state together with the high economic growth and also a relatively young demographic composition. So we just simply moved within the band towards the upper right corner. We began deserting from the band after 1990s, after the total benefits expenditures increased rapidly due to an unexpected speed of aging society, whereas the burden grew only modestly as the economic growth slowed down after 1990. Now the population is receiving more benefits than what they pay for, and such gap is expected to widen further if no reform is taken. So if no reform is taken, we expect the position of Japan to be in the upper right, up in the very top point where it shows Japan 2050 with no reform. So coming back, the issue of fiscal consolidation is it's identical to the issue of regaining the financial sustainability of Social Security system. And there are only three possible measures which could be taken, and none alone is realistic, and the three need to be pursued simultaneously. One is to accelerate economic growth, second is to raise tax, and the third is to reduce benefit increase. Just to show you the impact, if we were to do it only by raising tax alone, we can move to the position of France. We will basically move towards right. But that is only possible with a large tax increase, such as increasing VAT rate by another 20 to 30%. If we were to regain financial sustainability by reducing benefit increase, it will move down our position close to Canada's. But a cut of benefits by over 40% is necessary, and that option would not be accepted by the people. So therefore, the three options needs to be taken simultaneously. And in the latter half of my presentation, I would like to talk about the policies that we have taken or planning to take to tackle with this issue. Okay, first, with respect to policy on raising tax, Japan is in the midst of a program raising VAT rate. As Dr. Egerton introduced, I was the author of this program. It's not completed yet, but I wrote this like 5 years ago. The main points of the reform are as follows. First, to recategorize VAT as a special purpose tax for Social Security. Second is to increase VAT rate from 5 to 10% in 2 stages, 5 to 8 in 2014. 8 to 10 was planned in 2016, but has been postponed twice and is now planned in October 2019. Increased revenues will be allocated 50-50 to one, enhancing Social Security and reducing budget deficit. As shown in the bottom half of the slide, when this reform is completed, it will well, we were expecting to raise 14 trillion yen of tax revenue in addition, and we will use 7 out of 14 to reduce the budget deficit, which is approximately 1.2% of GDP. But the last half of the, and use the rest, which is 6.8 trillion yen to enhance the Social Security. I must confess that this is the political cost that we have to pay when we were going to ask people to raise VAT. Together with the nominal 3% economic growth, and the policies reducing expenditures growth, budget deficit is expected to meet the fiscal year 2020 consolidation target of reaching primary balance. But as I told you, the last part of the program, which is to raise VAT rate to 10% in 2019, is anticipated to be an important political issue in the coming years. As for the policies towards reducing benefit growth, numerical targets towards 2020 are stipulated in the Fiscal Consolidation Plan. I wrote this 2 years ago. The ultimate goal of the plan is to reach a primary balance surplus by fiscal year 2020. And as for the actual measures to achieve this goal, there are 3 major components in the program. First is to accelerate economic growth. The target is to achieve nominal 3%, real 2% growth. We have come up with various plans to boost the economic growth, but our economy is still way behind this target now. The second is to raise tax, I just told you now. And the third is to reduce benefit increase. This component centers on capping growth on Social Security expenditures. For other non-Social Security policy expenditures, the total amount is capped at nearly 0% increase in nominal term. The cap on Social Security expenditures growth is in the bottom box. It is stipulated in the plan as follows. We will keep the increase of Social Security expenditures between 2015 and 2020 within the level equivalent to the expected increase due to population aging. I'll explain about that later. The magnitude of this expenditure cut depends on the natural growth of Social Security. In fiscal year 2015 and 2016, the cuts each year was approximately 0.5% of the total size of the Social Security budget. The concept of increase due to population aging might be ambiguous. This figure, to illustrate this concept, this is a factor analysis of increase in healthcare, left-hand side, and long-term nursing care spending on the right-hand side. The actual growth is divided into 2 factors. One is other factors. Second is demographic change. As I explained in the bottom box, the estimates of demographic change takes account of the change in population in each age group while assuming per capita cost for each group unchanged. And so the so-called other factors is calculated as the residual, from just subtracting the demographic change factor from the actual growth. It includes the progress of medical technology, but also includes other factors such as the change of patients' or doctors' behaviors that cannot be explained by the advance in technology. So what is meant by the cap on Social Security budget is that the growth due to inevitable demographic change will be allowed, but for the growth above this, reforms must be taken to trim it down to 0. I just want to note that the plan does not intend to deny technology advancement. We rather encourage it, but the plan asks for other reforms that are large enough to offset the impact of technology advancements. So in other words, we're trying to trim down this green box to 0 and just admit the yellow part only in the coming years until 2020. Okay, in order to achieve the Social Security expenditure cap, 44 reforms agendas are stipulated in the Fiscal Consolidation Plan. The agenda can be categorized in 5 groups, so I'll explain the first 3. I'll just try to elaborate a little on the first 3 categories with respect to policy agenda for reducing this benefit growth. The first agenda is reviewing pricing policy. Okay. Now, first, with respect to pricing theory, pricing policy. 2004 pension reform was a big reform. It has significantly contributed to the financial sustainability of the system. Before the reform, it was a DB pension with consumer price wage indexation, and the current year's insurance premiums subject to increase indefinitely when average longevity increases or the growth of wage increases. After the reform, the DB pension after the reform, the amount of pension payment is not only indexed by consumer price or wage, but it is also adjusted further with the changes in the average longevity and average wage of the working population. With this mechanism, the premium rate schedule can be fixed towards the future with a ceiling of 18.3%. Currently, the premium rate is about 18.1, so we have another stage to go, and the premium rate for pension is fixed there, and we will only pay out what we got from there. We will only pay out what we got. On the contrary, the second bullet, as for health insurance and long-term nursing care, there is no such automatic financial stabilizer embedded in the system. Majority of pricing system is still fee-for-service, and therefore, if the number of patients or the cost per patient increases, the total expenditures and the required burden of the younger generation is subject to increase indefinitely. So just coming back to the prospect. Yes. The left picture that I just showed you, this is the prospect of Social Security benefits. As you can see, the pension, which is the sky blue box, stays in line with the economic growth, because during the projection period, GDP increases by 1.27, whereas the pension is expected to increase by 1.12, so it's within the economic growth. And as opposed to long-term nursing care and medical care, it is expected to increase above the economic growth rate, which so therefore the most policy agenda in the fiscal consolidation plan centers on these two systems, which is the long-term nursing care and medical care. As for the pricing policy, the fees for medical care and long-term nursing care are revised every 2 or 3 years. This revision is always the biggest political issue in the corresponding year's budget formulation process. I show you the current revisions of fees. The box shows the recent revision rate. I was directly in charge of the last review. As you can see, the numbers come down to like 0.004%. It reflects the difficulty of the negotiation. One thing that we've been cutting the price of drugs continuously, but although the price of drugs has been cut continuously under the past reviews, this cut only applies to existing drugs. The total drug expenditures have been increasing at an average annual rate of 3% due to a new listing of new drugs. So the recent discussions have extended to cut the cost of high-priced new drugs such as Opdivo. Okay. Sorry, I might take another 5 minutes. Sorry for this. Another important pillar of the policy agenda is to reduce the scope of insurance coverage. As I explained in the very beginning of my presentation, the public insurance system although it's modified in various ways, in fact, it's insurance. The main characteristics of Japanese public insurance are full coverage of public insurance to all citizens and full access to services. And I think they have been the virtue of our system. However, in order to restore financial sustainability, reforms towards reducing the scope of insurance coverage are inevitable, especially for services in the low-risk areas where individuals can handle on their own. So reform agendas stipulated in the Fiscal Consolidation Plan are such as excluding drugs for low-risk diseases such as mouthwash, wet compress pad, vitamin from insurance coverage. You might be surprised that these are still coverage under our public insurance system. Increasing the usage of generics for post-patent drugs. Within this is a comparison, international comparison of generic drugs share in the post-patent drug market. Japan is, in 2013, it was 46.9%, way behind US or UK. Now it's close to 60%. I have set the target in the plan as 70% in 2017 and 80% in 2018. There will be a sanction to hospitals and pharmacies if they do not achieve this target. So, so they are trying hard to reach this target. Otherwise, they will have to face a loss of income. So I built this plan as such. Further possible reform to differentiate, I've been talking about excluding drugs from the public insurance, but further possible reform is to differentiate insurance coverage ratio on drugs according to their effectiveness. You might be aware in France, the co-payment rate differs according to the characteristic of the drugs. It starts from the 100% individual payment for vitamin, and then it decreases. And for drugs with no replacement available, the insurance will pay 100% for that. As opposed to in Japan, the co-payment rate is flat for all the drugs, and I think we have to reform this in line with reviewing the scope, reducing the scope of insurance coverage in the low-risk areas. Also, we are trying to reduce the insurance coverage of long-term nursing care to beneficiaries with relatively high level of ADL. I think Korea and Germany has public insurance systems quite same with Japan, but we cover until ADL 6 under this public insurance system. But under this circumstance, we are trying to narrow down the scope and include, reduce the insurance coverage for the high level of ADL people. Okay. Now, sorry. The last pillar is increasing the effectiveness of service providers. The most important reform needed under this pillar is to reduce hospital beds. The number of beds per capita, as you see in this box, in Japan, is about 3 to 4 times larger than that of Germany, France, and UK, US, as you see in the red circle. Typically, there are oversupply of beds for acute phase and irrational regional differences in the number of beds per capita for chronic stage, chronic phase, which is unexplainable by the difference in the demographic composition. The number of beds per capita are highly correlated with the level of medical costs per capita in each prefecture. The new plan for conversion or reduction of bed is undergoing. For general beds, the plan aims to reduce oversupplied acute phase beds to meet the real needs of patients. The real needs of patients and the resulting targeted number of beds are calculated using past diagnosis data of all inpatients in each prefecture. With respect to beds for chronic stage, the plan aims to reduce regional disparities by half and move excessive patients to long-term care or home care. Now, this is the last one. Another aspect of reform toward increasing the labor productivity of Social Security services is to increase the labor productivity. The government economic growth package incorporates various measures to increase labor productivity, such as the utilization of IT or AI technologies in the long-term nursing care. Reducing the required unit labor force is vital, not only for the reduction of Social Security costs, but also for the growth of economy, where we expect a large decline in the number of total labor force in the near future. The upper figure shows that Japan expects to see a decline of labor force by over 10% between 2000 and 2030. But on the other hand, due to aging society, additional 4 million, which is about 5% working force, are required in the Social Security services, the lower part, which means that for other industries, we are facing close to 20% decline of labor force if we keep the same labor productivity in the Social Security market. So this is why we think that the labor productivity increase in the Social Security area is also vital for our economic growth. So this is it. Thank you for your time and attention. Just to summarize, restoring financial sustainability of our Social Security system is inevitable. We have set the numerical targets for that. But however, in order to achieve the goal, we need to politically persuade the public. Thus, the reform agenda is carefully built in a way not to undermine economic growth, and not to give up the quality of service, try not to influence the quality of life or ADL of the beneficiaries, but still we have to reduce the total size of benefit and also increase the revenue to bring back our system into a sustainable stage. Okay. Thank you very much.
Thank you. Thank you very much for that comprehensive overview. So we have a few minutes for questions. Any questions for Mr. Unami?
Should I stay there?
Yes, please. She's going to ask.
Should I stay there? Okay.
Yeah. Okay, go ahead.
Very interesting conversation. Thank you so much. One question I had was about one of your earlier slides where you looked at the rate of increase of healthcare costs over time. And you identified the portion of the increase that's due to population aging, the predictable part. And the residual was due to unexplained. And what was struck me in that picture, exactly right, is the huge difference in the residual across years. That is, in 2012, it seemed like it was very, very small. Maybe you're successful in getting things back to low growth, but by 2015, it's very high again. So can you speculate on what drives that increase in the residual, and is there any way to control it more directly?
Yes. That's a real good question, and that's a question that I've been often asked in Japan also. We cannot explain this. There are various components in this other factors. Like for example, when there's a wide spread of flu in the winter time, then the total amount of the growth rate increases. That's a quite understandable factor, but there are also other factors. As you can see, just on the left side, it says revision of medical fee. This is the revision of medical fee every 2 years. We do that. And there is a change in the behavior of doctors after the revision of doctor fee. It often happens that the growth rate is small on the year of revision, but in the second year, doctors find a way to dodge our cuts, and it tends to grow again. And also the third one is if there is a new drugs listed, a big new drug listed, and then that will contribute to increase. We would try to encourage those technology advancement, but there are other factors that cannot be explained by technology. And we are trying to narrow down those kind of inefficient behavior of patients or doctors to zero through reforms.
So you have these three strategies: raise revenue, reduce expenditure growth, and get higher GDP growth. And it seems like the thing that would help all three is reform, labor market reform, extending retirement age, and there are a lot of other issues that come up with that. Did I miss it? Is that a part of what you're proposing, or is that not on the table?
Yes, that's the agenda number one this year under the Abe administration, which is the labor reform, labor market reform. We're trying to. We have set a cap on the overtime working hours, and we're trying to raise the labor productivity in the market. Also, there is a large spread in the this moment. I'm sorry, just.
You want to say it in Japanese?
Non-regular workers.
Informal.
Informal. Yes. I was searching for that. I'm sorry. It's 5 o'clock in the morning in Japan. I flew last day, so. Yes, informal workers is a spread. So we're trying to increase their wage according to their responsibility. So the labor market reform is a big issue, and it will be combined with this reform together. Yes.
Does that include extending the retirement age?
No, not exactly. We are in the midst of raising the starting age of pension now to 65 gradually. We have no plan to extend that further at this moment because the actual reality has not followed this. The actual reality is that most of the companies' retirement age is about 60, so people will face a certain period without salary and without pension. And so if we are going to extend the starting age of pension further up to 65, we have to make sure that the retirement age is also coming together with this. And we were not able to persuade the companies to adopt those kind of a high retirement age at this stage. But it is definitely that we have to talk about this, because when the longevity, the average age of Japanese is like 85 to 90. It is expected in 2020 that for women, the average age of Japanese for women is about 100 in 2030. So we cannot just tolerate paying pension for 35 years, 1/3 of her life. So we have to talk about that. But at this stage, we are in the midst of raising the age. So it's another agenda coming.
Thank you very much. I'm sorry we've run out of questions, time for questions, but we'll have more time as he's around. So thank you very much, Mr. Unami. And I invite my co-chair, Professor John Chauvin of Economics and the Stanford Institute for Economic Policy Research, to introduce our next speaker.
Well, having heard that talk, I wish American policymakers were as clear-thinking on these issues as we just heard. In preparing to introduce Olivia Mitchell, I was reflecting when I was just starting out as an assistant professor at Stanford. At my invitation, Jim Tobin came to Stanford to give a talk, and I had to introduce him. And I was quite nervous about this because he was a big shot and I was an assistant professor. And I came up with the what I call the Chauvin rule, which is the better known the person you're introducing, the shorter the appropriate introduction, because the people are there to hear the speaker and not hear the introducer. And they know who the speaker is. So I thought about that Tobin thing, but I gave a very short introduction to him. I thought, well, how long should I spend introducing Olivia Mitchell? And with those standards, I thought I should be very brief, because she's very well known. Now, she is the executive chairman of the Pension Research Council at University of Pennsylvania, Wharton. She's a chaired professor. Her chair is a great title, something like the International Employee Benefits Chair. She has won a number of awards. She's a research associate of the NBER. She was named one of the 10 top women economists. She was named one of the 100 change makers in the world. So she's got all kinds of honors. The last one I'll mention, but this is a short selection off a long list, is she won the Paul Samuelson Award for writing on lifelong financial security. And it's a prestigious award named after, of course, a great economist. But Olivia Mitchell herself is a great economist, and we're honored to have you here.
While we're getting started, thank you very much, and thanks, John, for your very kind introduction. And thanks to Karen Eggleston and to Stanford for including me in this discussion today on the economics of aging. I found the last discussion on Japan very sobering. And I was saying to David Canning next to me, I said, I'm glad he has that job and not me, because you have a very hard job. But congratulations on doing great things. So what I was asked to do today is talk a little bit about the perspective from the rest of the world. Of course, as I am an American citizen, I'll talk primarily about that, but not exclusively. What I want to talk about is some of the big challenges that I think we face in the US and around the world. Of course, we saw in the wake of the financial crisis that many people lost a great deal of their retirement nest egg. Even though markets have recovered a little bit, people are still very, very scared, very frightened. And then, of course, the recession took its toll. Many people didn't have jobs, and it's still an issue in much of Europe. And of course, the long-term trends are growing clearer. So against that backdrop, I'm going to be talking about a number of challenges and solutions. So I start with the famous Franco Modigliani, who won his Nobel Prize for the life cycle theory. So basically, whenever you're born, this is economically born. So let's say you enter the labor market in your 20s. Hopefully your salary goes up over the life cycle. At some point, especially in the traditional setting, you retire. That's capital R. And if you do the right thing, when you die, you've run out of money, right? So what you should be doing is saving some of your earnings, saving, investing, putting part of your money into pensions, and then smoothing at least your utility, maybe your consumption, drawing down your assets until retirement. And so the three distinct sections of my brief talk today, will be focusing first on challenges during the saving phase. Second, what about the investment process? And third, the decumulation phase. So let me start with a brief discussion of some of the challenges of saving that we confront. As many of you know, I've been working now for probably 20 years on financial illiteracy, and I'll talk a bit about that. Second, I just want to remind us, even though we're in the business of thinking about retirement preparedness, saving is actually no fun. I don't know about you, but it doesn't give me utils to save. It gives me utils to consume, and the rest of the world is much like that. And of course, all that's happening against the backdrop of the social security systems, as we just saw in Japan. So with Anna Maria Luzzardi, we developed what has come to be called the big three questions. And I show these questions because in an audience like this, of course, you're all very sophisticated, you know the answers, but a surprising number of people can't answer these questions. And we started out asking these questions actually in the health and retirement study. So it was a survey of people over the age of 50 on the verge of retirement, more or less, and we were shocked at how little these people knew. So the first one just says we didn't want people to bring out their calculators and start doing fancy math. We just said, let's say you have $100 in a saving account, paying 2% interest a year. How much would you have in the account at the end of 5 years? Less than 102, equal to 102, or more than 102? And the answer is, I know it's after lunch, but the answer is, you got it. So we're cooking with gas. Second, inflation. We haven't had a lot of inflation yet lately, but rumor is it's coming back. And the question is, do people understand how to think about that? So the question that we have is, imagine the interest rate on your savings account is 1% a year, inflation's 2% a year. After 1 year with the money in this account, would you be able to buy more than today, the same as today, or less than today? Answer? You all get an A. All right, last question. This is the hardest question. It's the most difficult in the sense that it's talking about risk. On the other hand, it's an easy question to answer because it's a true or false question. So you have a 50% shot of getting it right. True or false, buying a single company stock usually provides a safer return than a stock mutual fund. On this side of the house?
Wrong.
Excellent, very good. So you guys rule, you get it, right? What do Americans say across the economy? And this is from a 2009 FINRA study. This is people all ages, right? So the interest rate question, only 65% got the question, if interest is 2%, after 5 years, do you have more than equal to or less than 2%? 21% got it wrong, and 14% refused to answer. And so this is starting to give us a sense of the financial illiteracy people face. After all, if you don't understand interest, simple interest, much less compound, how can you understand credit cards, rent to own, right, mortgages, etc.? Inflation, about just shy of 2/3 of the folks knew that. The risk diversification, it turns out that I told you had a 50-50 shot of getting it right, about 52% get it right. And if you look at the people who have no clue, 34%. So this is a pretty poor performance among Americans. In fact, only about a third got all 3 questions right, and fewer than half got the first 2 right. So this shocked us. This absolutely shocked us. So then we started doing the same kinds of surveys all over the world. And I know from having sat at the back of the room, this is a little bit difficult to see. So 57% of Americans could get 3 out of 4. I put up, I highlighted, let's see, the 4th one is Canada. I don't think I've seen Japan in this. So maybe we can talk later. Is Japan there?
It's the other yellow one.
After Hong Kong.
Okay, good, good. So the other yellow one, I know that's Australia. So I thought I was looking for Japan. I know there has been a financial literacy survey recently.
Last one, this moment.
It says Japan.
Oh, well, sorry. It's hard to see from down here. But at any rate, the point is that with a few exceptions, Denmark, Norway, Sweden, Canada's pretty good, but around the world, the levels of financial knowledge are very, very low. Cambodia, Vietnam tend to be among the lower ones. And in part, that's a function of development and exposure to financial markets, but it's also a function of the nature and type of education that we see. Another thing that we found in the US, and this has also been reiterated around the world in various other countries, so here we have the interest rate question, the inflation question, and the stock risk question. And the light blue bars, sorry if you're colorblind, the first bar on the left refers to the people under age 60 or 60 and younger that got that correct. You look at the next bar, the medium blue bar, that's people age 61 to 70, and the darker blue bar is the people over 70. And pretty much across the board, people are less financially knowledgeable the older they get. Now, there's still a question as to whether this is merely a cohort effect. That is, people my mother's age, she was 94 when she passed away, she wasn't exposed to the market. In fact, that whole generation was very anti-investment because they saw what happened during the Great Depression. But it may also be that some of these changes are happening with age. And so that's a remaining research question. The other issue is that around the world, in virtually every country we've looked at, men tend to be more likely to be correct. They get the questions right more often than women. So blue is boys, pink is girls, just to highlight that. And in every case, you see that men are more likely to answer the question correctly. I will add, however, that even when the men are wrong, they're very confident of their answers. Whereas the women are much more likely to say, I don't know, and potentially be more educable, more willing to take on financial literacy education.
That's new.
I say what? So one of the questions that this leads us to is, well, if people themselves are financially illiterate, then can third parties, governments, employers, and so forth, do a job helping us protect us from ourselves? But as we've just seen, social security systems are frequently facing insolvency. In the US in 2032 or maybe 2031, depending on the report, our social security system is going to be running short of money. The corporate defined benefit plans, and I don't know Japan so well at the moment, but last time I was in Japan, corporate defined benefit plans were in trouble, and they're certainly in trouble in much of Europe and in the US. And the public sector defined benefit plans are also terribly underfunded. And of course, if you go to the defined contribution model, the 401k model or 403b model, well, it helps a lot if people are informed, so they can do a good job saving, investing, and decumulating. So just to mention the US case, here we have, this is from the Congressional Budget Office, time on the bottom axis and the percent of GDP on the vertical axis. In about 2017 or around then, what you already start to see is the expenditures from Social Security, which is the solid line, exceed the tax revenues coming in. That's already the case. The lines have already crossed. But in about 2031 or so, the available cash to cover benefits will no longer be sufficient to provide for people's expected benefits, 2029, depending on who you talk to. So either the tax rate will have to go up 75, 80%, or benefits will have to be cut for everybody, not just you guys that are not retired, but all retirees as well as prospective retirees by about a third. So we're really confronting a huge, huge problem. If you look around the rest of the world, it's also interesting that many people don't contribute to Social Security. And this gets to your informal sector workers that you mentioned. So here we have the fraction of the workforce that's actually contributing to the pension. India, Philippines, China, some of the most populous countries on earth have very low incomes, but also very low participation rates. Japan, US, and Korea, and Canada, much higher contribution rates. So the good news in some of our countries is pretty much everybody's contributing. In some of the developing countries, there's very little prospect for increasing contributions a lot. Moreover, what you see is people spend a very long time in retirement. So this is the expected duration of retirement in years. And we've got Sri Lanka, China, Taipei, so forth and so on. The average time in retirement currently, without taking into account future improvements in longevity, is 19.4, and for women, it's 24.1. So this is all against the backdrop of people not saving enough, people not contributing in the formal sector. So a related point, and this is somewhat something that I think policymakers can help control and can help induce, is to make saving more fun. For many, many years in the UK, the British government has put in place a lottery savings system. So every pound you put in buys you a ticket to a lottery. And it's a typical lottery payoff structure where a few people get the giant check and they're on TV and everybody gets to feel excited about it. But basically, in expectation, the lottery payouts will just about pay a bank interest rate. But it's fun. It's a lot more fun to have the potential to go on TV. And this is something that's just been started here in the US with a credit union. When you sign up for a 12-month CD, certificate of deposit, and deposit at least $25, you receive one ticket for the lottery. Every extra $25, you get another ticket, up to a maximum of 10 chances per month. And so here they're winning $25,000. So it's a lot more fun to save that way than to do it the usual way. So what are some solutions? Obviously, I'm a big proponent of financial literacy. There's a lot of evidence now that people that are educated, they plan more for retirement, they save more, and they end up with a lot more retirement wealth. Sometimes plan design can make a big difference. So automatic enrollment has swept the US. Mandatory defined contribution saving has been in place in Chile now since 1981, Australia more recently. Singapore has obviously the Central Provident Fund. And many states and some cities actually in the last few years have started to try to push state-run employer saving accounts. The Trump administration seems a little bit against that, but I still think it has some potential. And of course, the other thing is, back to the question that was asked of Mr. Anami, we're going to have to work longer. There's absolutely no question. And there's a lot of evidence, and we can come to it if you want in the Q&A, about the fact that many people can work longer given enough incentives. Of course, as soon as you start talking about working longer, this is what happened in Europe, in Greece, in Italy, in France, right? Not popular. In the US, no, I'm not going to work longer, don't even think about it. So it's very, very unpopular. And this leads us to our second set of challenges. Even if you save enough for retirement, the money might not, in fact, grow very quickly. We have to worry about fees. We have to worry about home bias, people investing only in their own country and not diversifying their investments. And then against all of that, there's the challenge that we're in a very low expected return world. That's going to become more and more challenging for us and our children. And then finally, I worked last year and the year before on the Chilean Pension Reform Commission. And this is a big problem, the potential for government intervention and poor transparency. So I'll just say a couple words about that. So in the US, we have, and let me explain, we have along the horizontal axis, we have time, and along the vertical axis, we have the fees that are charged for investors in retirement accounts. And these are in equity funds. So the orange line on top basically says in 2015, people were paying 131 basis points, or 1.31% of assets under management for the privilege of investing their money in equities. And that seems high. It has come down. But the lower set of bars actually refers to asset weighted. So what we're seeing now is not the average across all funds, but the asset weighted, and it's come down quite a bit, 68 basis points versus around 100. In Europe, when you talk to folks there about investments in retirement accounts, it's 1.75% per year of your assets are being eroded in fees and charges. So I think we can push a lot harder on that front. We also have to think about more about asset allocation. Countries have had a diverse approach to how much they want to put in equities, how much bonds, how much cash. Alternatives are becoming very popular now. Infrastructure, hedge funds, private equity. But some of those have the potential of delivering a little bit higher return in expectation, but they're also much more expensive. So we have to be attuned to that. The US is actually very widely known as having the biggest home bias. So the US is the top brown line. This is the percent of equity held in domestic companies versus international. And we're quite a bit higher than other countries in terms of we're not very well diversified. And so it's also the case that some of these other countries, like, for example, Australia, are smaller than we are. But by and large, we should be doing more to invest in a diversified portfolio to get the benefits of that risk pooling. Finally, I just wanted to talk about the environment that we're confronting in terms of low interest rates. I have two daughters, both of whom recently, thank goodness, got jobs. And so they called me and said, Mom, what should I invest my 401k in? And how much should I save? So I said, well, in an environment where you have a real return across the top of 3%, and you're going to say, let's say you're going to save only 20%. So, I mean, only 20 years. You start, say, at 45 and you hope to retire at 65. Well, then you ought to be saving at least 27.5% of your income to be able to get to a replacement rate, which is half of your lifetime earnings, on the assumption that Social Security will still pick up some portion of your consumption in old age. On the other hand, if you started young, like everybody here I'm sure did, you only need to save 11%. Now I say only, but if you look at the default saving rate in most US pension plans, how much is it? 7. No, it's about 3%. So you'd be surprised. Maybe you're in a good plan. So many employers have been reluctant to put 11% as the default saving rate, figuring that people will just pull out if they're given the option. So this is in the state of the world. We have a 3% real return. But many people think that we have, at best, a 1% real rate of return. So if you start saving when we have 40 years to go, you should be saving 22.7% of your income. And this is just for retirement. This is not for houses or sending your kids to college or anything like that. If you wait until you're 45, then you're going to be saving 45% of your retirement, of your income for retirement. Now that starts to look pretty impractical. So I negotiated with my daughters and we ended up with an 18% saving rate, which I was very proud of. But they still have 40 years, I think. But this is the world that we're confronting, and it's not people who are in the know. Don't project very optimistic stock market improvement performance over the next 30, 40 years. I'm very worried about the political risk of government controlling pensions. We have Hong Kong, which is mostly private, China, mostly public, Taiwan, Korea, Japan. For many, many years, governments have said, well, we're going to put this money in a safe asset, namely government bonds. Well, that's sometimes safe, sometimes it's not so safe, right? Who knows how the government bonds are invested? Maybe they don't keep track of inflation. Even more worrisome, over the last several years, governments have actually gotten much more active in taking private pension assets. And to me, this is a huge concern. So back in especially the financial crisis period, Argentina, Ireland, basically helped themselves to a majority of the private assets people had saved in private pension funds. Hungary and Portugal, Russia has been taking the contributions that were intended to go into private pension assets and using them to fight the war in Ukraine. So basically, you're not protected against confiscation, even if you thought maybe private pensions were more secure. Could it happen here? Yes, I think it could. So obviously, taxes are one way your retirement assets can be confiscated. That is, we've told you you can put your money in the US in a Roth account such that it's not going to get taxed when you retire, but wait a minute, maybe it will be. Inflation is another way of reducing your account value. Any kind of means-tested government program. So if you have a lot of retirement pensions, and you thought that the pension payouts would be protected, wait, if you may have to spend down those assets before you can get Medicaid, nursing home access, and so forth. So I think we have to be very attentive to that. And of course, we have seen examples in the US where the federal government has actually, quote, borrowed, it did pay it back, but it borrowed from federal employees who had saved in what they thought were protected thrift saving plan assets. They did pay them back so far, but again, the question remains. And as I said, I worked in Chile on the retirement pension scheme there. They have about $163 billion in private retirement accounts. Currently, there's a wave of populism spreading across the country demanding that this $163 billion of people who've been saving for 20 plus years be redistributed to the poor, and they want the country to go back to a pay-as-you-go scheme, which is highly undesirable because it has a very rapidly aging population, so there's no one left to put a pay-as-you-go system back into account. So what are we going to do? It's tough, right? I think we have to have better default investments, higher saving rates, better governance to the extent we can. Some governments have proposed higher regulation such that the money can only be invested in safer assets, but sometimes this backfires. So it's not a simple situation. So we've talked about saving, we've talked about investment. The third phase of the life cycle of retirement saving, if you will, is what do you do during decumulation? And I'm very focused on longevity risk. How can you avoid outliving your assets? And also what's going on with aging and cognitive functioning at older points in the life cycle. So this is just a picture. I took it from some Australian data. Let's say you have a traditional couple, male age 65, female age 60. Back in 1975, they had about a 1/3 chance of at least one member of the couple living to age 90. Run the clock forward, they have now about a 2/3 chance of living to age 90. So what this makes you understand is not only are we living longer, but more of us are living to our lifespan, meaning there's much more potential of running out of money at older ages. There's also a lot of uncertainty. So here we have a picture of longevity risk. On the vertical axis is the period survival probability from age 20, and along the horizontal axis age. So basically, if at age 20 you want to predict what's the chances I'll live to 90 based on historical demographic data, what you see is that the bounds are very, very wide, between 20 and 60%. So it makes it very difficult to figure out how much assets you need and how you can draw them down in old age. On top of these complexities, financial reasoning falls with age. I'm sure no one in this room has this problem, but what you can see is depending on whether you look at the basics of financial reasoning, borrowing, investment, insurance, sometime, well, I don't know, sometime after age 60, people's capacity starts to decline. And certainly by the time people are 85, they're not going to be in a very good position to make financial decisions. Moreover, their confidence in their ability doesn't decline. And that's something that obviously is problematic for those of us that are dealing with aging parents who are not wanting to relinquish their financial decision making. What can we do? I'm a big fan of payout annuities, insurance products which protect you from running out of money when you're old. I'm also a big fan of deferred, or what we have started to call longevity income annuities. That is, at age 65, you can buy an annuity very cheaply that will start to pay you if you're still alive at age 85. And you can do this with just a little bit of your retirement account and generate a fairly good amount of income. Participating annuities are another product which I think TIA offers, the plan covering American university and research folks. And some countries, to protect you and to protect them, the governments are now requiring mandatory annuitization, such that, for example, in Singapore and Germany, at some young age, say 55, you must buy a deferred annuity which will start paying you at 75 or 85, thereby protecting the government from you spending all your money and coming back with your handout saying, I'm poor, feed me. And I think that's a very interesting outcome. So just in conclusion, I think if we're going to do a better job at understanding risk of old age, first of all, we have to identify the risk, because if you don't even know what the risks are, you can't do much. You have to mitigate the risks when possible, and part of that would involve potentially working longer so that you don't need so much assets to draw on throughout your old age. And then try to think of better products that can help us finance and insure the risks if possible. So last but not least, how do we do that? I think we're going to have to save a lot more, invest a lot more in financial literacy, make sure our savings work as efficiently as possible. And if you don't, what's the future of old age going to be like? So here's my joke for senior citizens. He says, look, honey, I've been drafted back in the Army. And she says, that's nothing. I'm pregnant. So that's the future of old age. So I finished. We have a whole bunch of different books. You can download all these free online, and I'd be happy to take any questions. Thanks a lot.
So I think we have about 10 minutes, maybe 12 for questions. Actually, if I could ask just one question, which is the trust fund's demise is now in the planning horizon of today's retirees. How should they think about that in making the rest of their plans?
A lot of financial planners ask me this question because after I tell them how things are going to hell in a handbasket, they say, well, how shall I talk to my customers? And of course, I don't take any fiduciary responsibility for your decisions, John, or anybody else's. But what I say is it's reasonable to assume that benefits could be cut by 30%. So if you're being cautious, think about whether you could live with that. If possible, you should delay claiming your benefits because as we know from work that Gopi and you and I have done, if you delay claiming your benefits from age 62 to 70, and 70 is currently the oldest, which you probably want to delay claiming, your benefits rise by 76%. Your monthly benefits. I actually said that recently to a Senate Aging Committee hearing where Senator Elizabeth Warren was in the group to whom I was speaking, and she said, I didn't know that. So I thought, well, if our lawmakers don't know that delaying claiming is a really good deal for most people, not for everybody, then we should spread the word more than we have. So I would say delay claiming, that gives you more degrees of freedom, assume 30% less. It probably won't be that bad. But the other thing we know is, I believe, taxes are going to be a lot higher in the future. And means testing is going to be more pervasive across the board. So since there's so much political risk and so much uncertainty, doing whatever you can to delay drawing down your assets might make sense.
Anybody who has a question? Just blurt it out. What do you got?
Yep. So the more I hear about the story from economist Osami, I was kind of depressed because I plan to actually go back to Japan at some point in my life, and then the more you hear, the more depressed you are. But at the same time, when I hear from your story, I think it's not that bad. I guess all the kind of people are actually suffering from the same kind of issues. I guess I had a question to actually him, but how does actually immigration policy actually plays a role in the sense that because one way to actually increase the kind of labor force participation, and then the labor force is just have more people coming outside of the countries, and then in Japan that's not really that much options, and then maybe it's not really the case right now in the U.S. as well. But I was kind of wondering maybe if you have less kind of immigrants, maybe it's gonna actually make things even worse than
I think it's undeniable that our current immigration policy, in fact, our historical immigration policy, has not been very sensible from an economic point of view. That is, in the US, we've typically had a policy that says we let people in for family reunification purposes, but typically the family that comes in is not young and eager to work. It's grandma and grandpa, and they don't necessarily help from an economic perspective. And then the other thing we've done is we've focused on, political refugees, which may or may not contribute, but it's not been that big a number. I think countries like Australia have been much more sensible, Canada, so that they identify folks that have rare skills that are in demand, and or people with, I don't know what the current price is, $1 million to become a resident of Canada, something like that. So at least you have some wherewithal to contribute to the economy. We haven't done that. Now, of course, in the past, we've had a lot of illegal immigration, but that seems to be turning around, and we'll see what happens with a wall. So that, I think, will be to our detriment, actually. And especially if you look at the areas in the service sector that are growing the most quickly. The people that are delivering home health services to my mother and maybe your father, they're Haitian, they're Central American, they're Latin American. And if we close off those conduits, it's going to be even worse of a problem than we have now. Go ahead.
I'm just curious if you could say a little bit briefly about the Chilean experience. I mean, that was quite an interesting experiment, and it sounds like you've just been there. What's the good news and bad news from that?
Well, the good news is that the private mandatory defined contribution account started back in 1981. 10% of your pay had to go into these accounts. They were invested pretty well. Their real rate of return has been phenomenal since 1981. But since then, people are having a couple of recriminations. One is, of course, the government that imposed the private accounts was Pinochet's military dictatorship. And even though that was a long time ago, people still remember. In fact, the president's father, I think, was murdered under that regime. So people are still looking back at that with a lot of bad feelings, and I understand that. But the other thing is that the populist argument has been, we were told we're going to get 75% replacement rate from 10% contributions, and they're not getting it. Now, there's a couple reasons. One is very few people contribute their whole lifetime. If you were self-employed, you were allowed to opt out. If you were informal sector, you didn't pay in. So people are getting to retirement age now with maybe 10 years of contributions. That's just not enough. But of course, then the populists are fanning the flames to say, oh, we can give everybody free money, 163 billion, and we'll let the future take care of itself. I think there also is as we've seen, a wave of populism sweeping the globe. And so in that sense, Chile is not that different. But they had such a successful program that I see that with great sadness.
Yes, thank you for bringing the experience of Chile. I am Peruvian, and I know very well the system. But for me, it's a bit complex to say that all these big demonstrations are just populism, because sometimes the societies, they want to have a different social contract, and maybe these societies, they want more solidarity and not the private system of Chile. So maybe you can say something more about this, because the statistics I read, that the figures say that people who has contributed maybe 20 or 30 years in Chile, they are just getting 33% of replacement rate. So I don't know if this is true or not, but maybe you can say more words about this.
So we could have a much longer discussion, and I would welcome that, actually. But quickly said, from 1981 until about 2008, there wasn't really much of a what we call a solidarity social security pillar in Chile. In 2008, the president, who was then Michelle Bachelet, who's back again the president now, she put in place, I thought, a very good reform, which said, if you get to retirement age and you're really poor, then we're going to give you a means-tested benefit. So that was in 2008. And then a couple of years later, it was improved even more. So in fact, the Chilean system is not just private accounts, and I think this is something we get wrong in the US a lot. It's a two-tier system, in fact, three-tier system, with this fairly generous old age poverty benefit, means-tested benefit, the private accounts, and then if you want, you can contribute more on top. But I think one of the problems is that the government never educated the people about the system. If you look at financial illiteracy in Chile, it's terrible. People can't answer those three questions that we have, plus many others about the nature of the system. So to just assume that everybody will love the system, I think causes a lot of misunderstanding, and they let people down in that regard.
Let me ask one final question, if I could.
Yep.
You were on a commission to ensure the solvency of Social Security 15 years ago or so, and part of that talked about price indexing versus wage indexing, and then later there was this proposal of so-called progressive price indexing. Seemed like kind of a good solution, but here nothing happened. Do you have any reflections on our failure to address these problems 15, 20, 30 years ago? We've known about this problem, and now we've let it creep very close.
No, I think you're absolutely right. So I was on the Bush bipartisan commission to strengthen Social Security back in 2001. So the good news was that both the, let's see, how do I make this? I don't know a Mac. How do I make it look like a slide again? Both the Clinton administration and the Bush administration had proposed, thank you, investing part of the assets in private accounts. Now, this was back in 2001, where there was still an excess of revenue coming in vis-a-vis the payouts. And so there was an opportunity at that point to try to allow people, so the President Bush said, we don't want to force people into private accounts. If they want, they would have the option of investing a portion, a third of their contribution into private accounts, to do a limited menu. And in turn, if you did that, of course, you wouldn't get your full benefit because you're not contributing your full contribution. Right now, we're not facing that anymore. That is, the water's gone under the bridge. Unless we dramatically increase taxes and or cut benefits that are scheduled, there's no cash to do it any longer. I did not, and I still don't believe that private accounts are a way to make a lot of money without risk in the stock market. We know that's not true. But what I do say is that back then, when there was an excess of revenue coming in vis-a-vis expenditures, the money went to Congress and Congress spent it. So there really was no way to set aside that money and protect it from being spent. So that was really the reason I proposed the private accounts, to get them off the books of the government. All right.
I'll give you
One last?
Yep.
So my question is, I'm really sympathetic with your argument of making savings more fun, and I think it is the way to go. But I rarely hear about making expenditure less fun. Because we keep bombarding people with publicity, and I'm sure they don't know how to answer the questions about financial literacy, but they know how much the last iPhone costs. And then it's very difficult to save, no matter how fun it is. What's your thought on that?
To be honest, I think we have to actually start in childhood. When I had two kids, they'd all say, I want this, I want that. So pretty soon, when they got to be about 6 or 7, I taught them about the Bank of Mom. And the Bank of Mom was an Excel spreadsheet, so they learned about Excel too. And what we did was we went through and tried to budget. So they went to a school where they had uniforms, so they didn't need clothes. And I would buy, the sports equipment or the winter boots or whatever. But anything, discretionary, they had to pay for out of their Bank of Mom. And they had an allowance. If they needed more money, they had to work. I admit I did not tell them about interest. I'm so bad. But interest were low. It was low there anyway. And what it did is it taught them how to budget. It taught them how to understand that if they get to go buy this, fine, it's from their account. But it means they don't have, and then they stopped complaining. And so I think that that was one of the most important things I could have done. Of course, it's not that they're perfect in every way, but it makes, if you don't understand budgeting, then you don't understand what the opportunity cost is. So I think that's really critical.
So do you think that financial education at school may be the one way to teach that?
Absolutely. I mean, Doug Bernheim here at Stanford has done some research on what happened when different states mandated financial education at different points in time. And so you could see the young people that had grown up in the high schools in those states that mandated financial education did better. They planned more for retirement, they saved more, and so on. So I think that's helpful, but I don't think it's one shot, right? You have to keep reinforcing it. Many employers are now getting into what they call financial wellness for their workers, because if they don't teach their employees to pay off the credit card instead of just paying the minimum, they're getting calls all day at work saying, hey, I'm going to come and get you. So I think financial wellness benefits people throughout their whole lifetime, but you have to keep reinforcing it. And in fact, in some work that I've done with Pierre Carl, what we show is it's not enough to do it once. You have to keep reinforcing it to make it stick, or else it depreciates, just like all the rest of human capital.
Hey, I think we should thank Olivia.
Okay, thank you.
I believe we have a 15-minute break, is that right? 2 o'clock?
That's right, yes. Convene at 2 o'clock. Thank you all.